What's up, traders? Anthony Crudele here, and welcome to this week's episode of Develop Your Edge. In today's show, I'm going to go over my process for scaling in and out of trades. But before we get into that, let me take you to this week's NinjaTrader Charting Edge. Now, pulled up an E-mini NASDAQ futures chart on a daily with a simple 10-day moving average. And because today we're going to talk about scaling, I wanted to go over something that I use that's super simple that really helps me determine whether or not I want to be a little bit more aggressive on the long side or the short side of a market that I'm trading. Very active in the E-mini NASDAQ futures, and something that I look at consistently before I begin to trade every day is where are we relative to the 10-day moving average? Now, why the 10-day moving average? My time frame as a trader is intraday, right? I might hold things for multiple days, but for the most part, I'm focused on intraday trading, day trading. So when I look at a market to identify what trend it's in, I typically only go back 2, maybe 3 weeks. So a simple 10-day moving average tells me what is the market holding above it or below it? How strong is the trend or how weak is a trend? Or are we chopping around it and maybe it really is not done much over the last 10 days? It's just a very simple thing that I'm using with the simple moving average to tell me what the trend is over the last couple of weeks. Now, I'm not using the 10-day moving average for any sort of trade indication. I'm using it to help me gauge which side of the market during the day I want to be a little bit more aggressive on. So, we're going to talk a lot about scaling today, but I want to go over really the premise of how I get to the point of knowing which side I'll be scaling into more aggressively or less aggressively. So if you look at a 10-day moving average, very simple here. Let's look at the late action that we've had in the NASDAQ going back just a few weeks here, February and March. As you can see, here's the beginning of February, grinding up above, holding above the 10-day moving average. Intraday during that time, I use my strategy and say, hey, look, at the last couple of weeks, we've been holding above the 10-day moving average. I'm going to look to be a little bit more aggressive on the buy side because really we couldn't even test it and we just consistently kept staying above it. So in my mind, I'm very skeptical of being short, and I'm going to focus more on long positions during the day. Then you fast forward towards the end of February to where we are here now in March, and we've been staying below it. And look at what's been happening. The market's been going lower, right? So you use a simple 10-day moving average to say, well, they can't get back above it. We've been staying below it. Be careful in being long and be a little bit more aggressive with your shorts. So to me, this is just a simple tool to where I come into the day and I know because the trend has been down lately, don't be in a rush to get in long. Be probably more in a rush and probably more aggressive with trading the short side. That's this week's NinjaTrader Charting Edge. Now, I want to pull up a tweet that I put out this past week. And like I said in the intro today, I want to talk about my process for scaling. I put this tweet out and got a lot of comments for it. Most traders are early getting into a position because we feel the need to be in a position or we fear that we'll miss the trade. Scaling has helped me tremendously with this. Let price come to you and scale in to feel the market and see how the market responds to your area. Let's go back to the NASDAQ chart. Here's my thought process when it comes to scaling into a market. If the trend is up, let's go back to February and the NASDAQ. The trend had been up, been staying above the 10-day moving average. If the trend is up, I am more aggressive with my buys. And when I'm scaling in, I'm going to scale in right at entry. So whatever entry I have for my intraday strategy, if it's long, I'm going to start to step in right as it gets near entry because I'm going to be less patient waiting to get in on the long side if the trend has been up, using a simple 10-day moving average as my guide to understand trend. And if it starts to go my way, I'm more aggressive to getting in as much of my position as I can, potentially even above my entry price, because in a bull market, what happens is a lot of times we don't get the full dip that we want. And when markets, especially these days, it's all about momentum. Markets stay bid and then they stay offered, as you can see here just with the NASDAQ. So my thought process is to scale in, see how it trades at entry, feel the market. If it starts to hold, then I'll scale in more aggressively. And this is all to the long side, and I'll get to my full position. Now, if I get a short signal, what would I do? In an uptrend, I'm not going to be in a hurry to get in at entry. I'm going to trade as close to my stop as possible. So let's just say I get a short entry when the Nasdaq's above the 10-day moving average and it keeps grinding higher. What I look for is where's my risk price? Where's my stop? And when we start to get really close to it, then I'll step in small and feel it because now my risk is really small. I have a small position on and I'm close to my stop. If we start to fall back down and get back below entry, I'll watch to see how it trades in my area, all about the reaction, then I'll start to scale in. This way, the scaling in process allows me to feel the market and not get run over right away going against a trend. When if I'm looking at a short in an upward trending market, I'm allowed to feel it, see how it reacts, and then add accordingly. So it's pretty simple. The philosophy in bull markets, add at entry or above entry on my intraday stuff. When a market is acting bearish below a 10-day moving average, it's vice versa. I'm going to look to sell on my first initial entry on my short signal. And if it holds, I'll get more aggressive and I'll try to get in as much as I can. But on the long side, I'm not going to be in a hurry. I'll wait to trade as close to my stop as possible. And like I said, this has really helped me because I'm somebody who likes to click the buttons. I like to be active. So when it gets to an area, sometimes a small position, I'll learn a lot from it. And once I see the reactions, then I could execute the rest accordingly. Now, I want to go back to a thread that some of my friends on Twitter were asking me questions about, and they were really great questions. Miad and Javi asked me a couple of questions, and I want to go over them because they were really, really good. And Miad said, once you're committed with a few positions, you are at your most vulnerable. How do you deal with a jittery market at that point? And I said, this is when time starts to matter to me. If the market is chopping around for a period of time and it's not doing what I anticipated, I either get out of the trade or get small and watch. So for example, there is no science to what I talked about today with scaling because it doesn't always work out perfect. I wish it does. I wish it did. What'll happen is, let's just say, for example, lately the Nasdaq's been going down and you get a short signal, right? And all of a sudden the market's just chopping around, as we know that Nasdaq could sometimes do. What I'll do is, especially if we're starting to get around the 10-day moving average, let's use that as an example as what we're determining for trend. I know that now we're in a choppy time and it's trying to figure out, is the market going to continue to go lower? Are we done? Are we turning back around? Nobody knows that exact moment. I wish we did. Then I just stay small, watch and feel how it's trading. And that's when I start to look at, I keep a timer up actually, and it'll say how long have I been in a trade. And a lot of times as intraday traders, if the reaction isn't working pretty much right away, I almost know that trade may not work out. It's not always the case, but time does matter. So I just try to get small and then, or potentially get flat and watch. And then Javi followed up and said, and if it starts to move in your direction after getting smaller, you load up again or just let ride what you are holding at that point? And that's just such a great question because, like I said, there's no science to this. It's always about what's happening that day and it's about reacting. What I look for simply is, and it's I wrote, it depends. If it's with the bigger time frame, I'll get back in. If it's a counter trend, mean reversion trade, then I'll stay small. And that's exactly the way I would approach this. For example, let's just say the Nasdaq gets above the 10-day moving average today. Going forward, it closes above it and starts holding back above it. Now I'm going to start to look to be more aggressive with my longs in the Nasdaq, using my intraday strategy. And if it starts to go my way in a long position, let's just say it chops me out of some of them, because the market's still trying to feel if it wants to hold above the 10-day, then it starts to go. I will get right back in because now we're holding above the 10-day. If we're back below the 10-day moving average and I'm long and it's not holding, it's chopping me around and it starts to go against me or starts to run my way, I won't be in a hurry to get back in because now I'm going against the trend. That's why sometimes a simple thing like a 10-day moving average can really just help clarify your thoughts throughout the day. It doesn't need to be perfect. Let's go back to that 10-day moving average. I mean, just look at it. When it stays above it stays above it for periods of times. When it stays below it stays below it for periods of times. When it's trading around it, I know it's going to be choppy. It just is. And I'm not using the 10-day moving average at all for any of my entries. But in my mind throughout the day, it gives me confidence with my execution. Right or wrong, at least I'm confident. And something as simple as this can truly help you develop your edge as a day trader. Hang tight, traders. I'll be right back with my final thoughts.
Why did I add futures to my trading strategy? 24/7 access to diverse global markets, like wheat. Can you say growth opportunity?
We should probably harvest that.
Final thoughts for today, traders. Remember, it's not always about something that needs to be complicated that can give you an edge. Something that's very simple, like the 10-day moving average that I use in my strategy, can be extremely effective. I'm not using the 10-day moving average at all for any sort of trade indication. I'm just using it to see, are we holding above it? Is the trend strong to the upside? Are we staying below it? Is the trend strong to the downside in my time frame? Or are we chopping around it and maybe it's a two-way trade and maybe I just sit back and watch for a bit? To me, it's about being confident in my execution. And something that's as simple as a 10-day moving average has done a lot of good for me and my intraday execution. Now, we talked about the E-mini NASDAQ today. I want you to remember there are also E-mini micro NASDAQ futures. To learn more about them, please visit activetrader.cmegroup.com. If you have any questions or comments, please put them down below. And if you're enjoying the show, click that subscribe button. You could also message me on Twitter. My DMs are open at Anthony Crudele. And don't forget to check out Instagram, Anthony C. Crudele. That's a wrap for today. See you next week.